Hi, and welcome to the Ignition series. I'm Jared Johnson. So happy to have you with us. This is a short video. We're going to discuss how to make money trading Forex. Now, trading the foreign exchange market, Forex, currencies, you've probably heard some of those terms, is just a little bit different than trading stocks and commodities and some of those other things. In stock trading, you buy some shares in a company. You buy stock in a company. In commodities trading, you're buying oil, you're buying whatever. In currencies, we're using money to buy money, so that's always kind of exciting. So let's talk about how that works and how that's supposed to go. How to make money trading money. So it's a fun concept. It's something I love. I've been trading for many years, and I love doing it. It's a really simple concept here. We're going to talk about buying and selling money, contracts and lots, pips, and leverage. What in the world does all of that mean? So, let's have a little peek. We're going to go over to a chart right here. This is a chart of the euro versus the US dollar. Now, in something like this is a very common setup for something that we would trade, right? So we will trade the euro versus the dollar. Let me just show you some details here. We'll trade euro versus US dollar. We'll trade Japanese yen versus US dollar, for example, and versus a lot of other pairs. We'll trade the Australian dollar, the Aussie dollar, and the New Zealand dollar, and we'll trade the pound, the British pound. We'll trade all kinds of things versus all kinds of things, right? We'll trade the euro versus the dollar, the euro versus the yen, the euro versus the Aussie, the pound versus all of these. So we just are trading currency, one currency against the other. And what we are taking advantage of is the fluctuation, right? So fluctuation is kind of a big part of all of this. The daily fluctuation in the currency exchange rate is pretty big. It's pretty big. It may not make the news. It may not be something that we hear about or talk about a lot. It's probably going to be pretty hard to find a news story about the euro increasing in value 1 penny against the US dollar. But when we dial down into the charts, 1 penny is actually a pretty decent little movement. And we're going to talk about what that is. Those are what we call pips. And we're going to talk about how we get into the market and start making pips by the use of contracts or lots and with the help of a broker. So let's go back over here and we'll just kind of diagram this for a moment here. You can see right here, you can see in various places up here in the corner, you can see over here, euro versus US dollar. Basically, in simple terms, what this means is we're looking at the exchange rate of the value of the euro versus the value of the US dollar. Now, for the most part, that first currency right there and that second currency, when we look at that, how do we kind of decipher what this means? Simply put, the US dollar, it takes $1.21 to buy 1 euro. So this price that we see right here, this 121.35.8, these are kind of, tenths and hundredths of a penny. This is what it cost the second one to buy the first one. So we're going to look at all kinds of different charts, right? Euro dollar and the yen and the Aussie and all of that. Whatever order they're in, it's always going to be what the second one can buy the first one for. That's what that number is going to be. Now, when I said a 1 penny movement, that's not really newsworthy. Well, it's definitely trader worthy because 1 penny in the exchange rate is equivalent to, we'll just write this here, so 1 cent in the exchange rate change equals 100 pips of movement. And that is pretty significant. We can definitely make some good money on 100 pips of movement. Now let's build on that a little bit. So 1 penny of change is 100 pips of movement. To give you a little bit of context right here, this is, let's just measure this little movement right here. This is, oh, how lucky of us. That is almost that's exactly 100 pips right there. That movement is 100 pips. Now, just to the naked eye, you could say, that's a pretty good movement. I could probably make some pretty good money on that. If you see a stock chart looking like that, or a commodities chart, or any other kind of chart, you're thinking, that's some decent movement. That is a 100 pip movement. That is 1 penny in change in the exchange rate. So there's some money to be made there. Now, how do we put this all together? Remember, we're going to be talking about contracts, lots, pips, brokers, all of this stuff. So there's a pip. A pip is just a hundredth of a penny of movement. One pip is 1/100th of a cent, and that gets our kind of bearing for how we're going to measure all of this stuff. So the next thing that we do is we would buy a contract or lot. And a lot is what we say in trading, in Forex trading terms. Now, you might say contract in commodities or something along those lines. Options, for example, we call them contracts. But in currencies, we call them a lot. It's one lot. Now, that lot comes with some leverage. And this is where the brokers will come in. So now we have brokers, and they are going to sell us a lot. And they're probably going to try to sell us on a lot of stuff, but they're definitely going to sell us a lot. Now, basically, what this will do for us is, as a broker gets us in and out of the market, the currency market is a huge, moving, big, massive market. And it used to be basically reserved for just banks. This was just banks trading money back and forth between each other. But now it's designated for all of us traders. And it's been fairly new getting the currency market to the consumers, right? It's only been the last 15 or 20 years that consumers can really trade actively the currency markets. So stocks, you know, the average person has been trading stocks for a long time, 100 years or so, but currencies are more like the last 15 or 20 years. So brokers are going to help us get in and out of the market. They're going to sell us a lot. And because it's such a big market, they're going to put up what we call margin. And that margin that's basically them lending us money. So, when we trade, and you might have heard margin, leverage, all of that stuff, and probably the better term here is leverage. We're trading on margin, so let's call this leverage. And this is, and again, so you've probably heard a little bit about leverage, and leverage is the double-edged sword and all of this stuff. We'll talk about that. We'll talk a lot about that, but brokers are giving us leverage. They're saying, if you put up $1,000, I'll put up $50,000. Now, we don't need to sign papers. We don't need to get a loan. We don't need to do any of that stuff. We don't have to have our credit checked. We don't have to. This isn't like trading on margin with options or stocks. This is a bit of a different situation. This is how the Forex market works. The broker just says, you put up a little bit of money, and I'll put up a lot of money. And the little bit of money that we're putting up is kind of our goodwill money. This is saying, I'm in the trade, I'm willing to put a few bucks towards this thing, and then the broker will put up the rest. So that is leverage, and that's basically how it works. Now, most brokers right now in the U.S., well, all brokers are 50-to-1 leverage. Non-U.S. brokers are 100, 200, and even more to 1 leverage, meaning in this kind of scenario, like I said, we put up $1 and the broker puts up $50. Outside of the US, we put up $1, the broker puts up $100 or $200 or whatever the broker has stipulated as their leverage. Again, you don't need to have collateral. This isn't a loan. This is just how the Forex market works, and this is how we make money doing it. So once we've identified a chart and a setup, and we know we want to buy a contract, and we're going to use a broker to get us into it, then we start to take trades. And the way that we make money doing all this stuff is, let's say that I have a $1,000 trading account. So with a $1,000 trading account, I'm probably going to buy a mini lot or a mini contract, which is a smaller amount. So I'll show you how this works. $1,000 account, I'm going to buy one mini lot, which is I'm putting up $200, and the broker will put up $10,000. And that is going to get me into a 1 mini lot contract. So 1 mini lot is equivalent to $10,000. It's equivalent to controlling $10,000 in the market. And as you can do the math, to control 100,000, a million, and so on, you don't need extensive amounts of money. You do need some padding and some money management. We'll talk all about that. But $1,000 account by 1 mini lot is going to cost me about $200. It's going to give me control of about $10,000 in the market. And that will make me about $1 per pip of movement. So in this example here, this is our trade, right? This is our nice little 100 pip movement that we just saw happen. So if I tied up $200 and I got a 100 pip trade, or a 1 penny movement, I'm going to make $1 per pip for tying up $200 of my $1,000 account. And that's going to make me $100. So that 100 pip movement on a $10,000 account is going to make me $100. Or 10% of my account, or 50% of my short-term holding investment right there of $200. So I hope that makes sense. This is essentially how we're going to get in there and trade. A pip is, once again, 1/100th of a penny. So 1/100th of a penny, or 1 penny change, is 100 pips. So 1/100th of a penny is 1 pip. We're using contracts and lots. We are using brokers to get us in and out of the market. They give us leverage so that we can control larger amounts of money with less money. Current leverage for the US, 50 to 1. Outside of the US, 100 or 200 to 1. So this is the very earliest stage of how we are going to make money trading Forex. I hope this was helpful. I'm going to explain a little bit more in detail about this, but this is a look, an overview of how we're going to make money. So quick little reminder here. Pips measure the movement just like inches or centimeters. Lots or contracts, that measures the amount. That's our units. Brokers make this all possible. They facilitate everything. They get us in and out of the market. The leverage, that's what allows us to not need to have millions of dollars in our trading account to make a little bit of money. We don't need to break the bank. We can start off with hundreds of dollars or a few $1,000s and be able to successfully trade this. I hope this was helpful in giving you a little bit of an overview of how we make money trading Forex. Thanks for watching, everybody. On to the next video now.